Well, I think one of the big supports for credit markets, in particular, since 2009, has been the fact that government bond yields have been too low for both pension funds and insurance companies to hit the targets that they need to finance their liabilities. And that continues to be very much the case. I mean, if you think that government bond yields will rise over the next 2 to 3 years, we might see pension funds and insurance companies moving back from corporate bonds towards governments. But for the time being, we're still not at levels which are attractive enough to meet their long-term targets, and the fact that they have very long-dated liabilities. So we're continuing to see government bond coupons being recycled into credit markets by both insurance companies and pension funds more generally.
Yeah, Guy, and ordinarily, I picked up on exactly the same point that Jeff saw in your copy about those institutions looking at the corporate bond market. But normally that would induce greater risk onto their balance sheet potentially. But given the fact that, let's face it, central banks have got the back of investment-grade corporate credit now, is that just a very smart move, getting ahead of the central banks?
Well, I suppose it's something that you see in every cycle, that when government bond yields fall too low for these types of these asset liability managers to hit their targets, they do move down the credit curve into corporates. And in that sense, I guess they're always ahead of the central banks in every single cycle when this happens. But I do think that, yes, it's the smart move because it does allow them to hit their targets. I mean, I think between now and the end of the year, we're going to continue to see credit spreads tighten, probably by another 50, 60 basis points in investment grade. And so as a result, they'll be generating good returns, and as you say, they have this kind of underpinning from the central banks, particularly in Europe, in the European credit markets.